This is Dave Wagner with Tidecrest Wealth Management. Thanks for joining us. Today we're going to be going through our March 2025 market outlook. Let's jump right in. So as you can see on the screen, this is our outline for the conversation today. It has quite a few topics on here. We get through them pretty quick. Each one of these bullet points probably has one, at most two slides. I won't read them right now, but you can kind of see what the focus is going to be. And we try to keep these pretty consistent from month to month if we can. That way we can kind of see progress over time, and it's easier for our listeners to kind of have some context when we're going through it. So first, this has been something we've been focused on for quite a while, is inflation. It really wasn't on anybody's radar for years. And then late 2021, inflation started to creep up. The Fed saw it. They realized they had to start raising rates to combat it. And inflation has been basically a staple of market updates, kind of macroeconomic updates since then. And so as you can see in this chart, right, we've had some fluctuating inflation over the last 12 months. This is a trailing 12-month chart. You can see the latest data was in February, which is 2.8%. The target, the Fed's kind of mandated, if you will, or stated target is a 2% inflation rate. You can see that we haven't been at that point at any time in the last 12 months. But we are heading in the right direction for the first time since September of 2024. You can see that was the last time that we saw inflation actually drop. And you can see, as the inflation has kind of crept up through late last year and the very beginning of this year, there's a lot of concerns about what that would mean for interest rates. And if you guys recall, in December of last year, the Fed came out and said, hey, everybody hold on. We're probably not going to cut rates as many times as you think next year. And that was really kind of a negative thing for the stock market, if you guys recognize that. So the fact that February was down, heading in the right direction is significant. And on this next chart, we always try to give it some context, right? So we go from the 12-month chart to the 50-year chart, and you can kind of see where we are, and you can see where we were previously. So that little intermediate spike in the middle of 2022 was over 9% inflation reading, and that's really when it peaked out on this cycle. But you can go back further into the 70s and 80s and see that we had two periods of time that were significantly higher than that, right? As high as 14.76% was the high back around 1980, right? So we really didn't get close to that. And we're getting close to where we need to be. So we're making progress. It's just been choppy over the last 12 to 18 months. So that really plays directly into the Fed funds rate. So what we look at here on this chart is kind of where the Fed funds rate has been over the last several decades, going all the way back to 1993. And what you can see if you follow that line along is as the rates really drop off significantly, those are meaningful periods of time in the market where they're trying to stimulate the economy, right? So you have the tech bubble, right, 2000 range. You have the financial crisis really in 06, 07 and kind of dropping off into 08. And then you see it flatline until it starts to creep back up out of the cellar and then really fall back down to earth right during COVID. And it's hard to tell from these lines. They seem like they're all going to zero. But really that low number in 2020, the COVID number, was the lowest on this chart, right? It was historical lows in a lot of different maturity periods on the Treasury and other fixed income curves. So now you can see basically we talked about it a minute ago, at the end of 2021, inflation became an issue. Fed started hiking rates. They hiked rates very aggressively throughout 2022. As you can see here, the Fed funds rate went all the way up over 5%. There's been a few cuts since then. We're now really at about 4.33 is the effective funds rate of what we're seeing. But somewhere in that neighborhood, I think the range is 4.25 to 4.5 is what we're actually in that range. And you can see some projections here in the blue and the green and the purple of what the expectations are going forward for Fed funds rates. So expectations are that rates are going to drop. They're not dropping as fast as people had initially expected, but that's something that we're dealing with in the market. I think it really has digested already. So next we're going to focus on the yield curve, right? So what that really means is we're talking about yields. We're talking about treasuries, specifically U.S. treasuries. So in this particular case, we're looking at yields in different time periods. You can see the dark navy blue is really the current time period. This is the end of February, just a couple weeks ago. And so you can see it's starting to get a little less inverted. It's actually not inverted anymore over the long term. You're starting to see 30-year yields at 4.5 versus short-term yields, like the 30-day yields, 90-day yields at 4.3. So first time in a while we don't have an inverted yield curve. We had that for the last couple of years. But you still have a bit of inversion on the front end of the curve, right? So you go out 2-3 years, your yields are lower than the 30, 60, 90-day yields. So we expect to see more flattening of that and eventually see the short-term yields be lower than the 2-3 year yields. It's always fascinating to point out, if at the bottom of the chart you see August 2020, and you see where the yields were then, it really is a striking number. I mean, almost zero on everything under 3 years, and then you had the 30-year barely over 1% historical lows. So I think when you're looking at a yield curve chart, it's pretty boring stuff typically, but I think there's been so much movement in the last 5 years. It is interesting, and the fact that we had an inverted yield curve over the last few years as well. It's also, I think, fascinating, more than normal. So the next thing is we'll talk about the labor market. So the Fed, they're talking about cutting rates. They're really looking at growth and looking at inflation, GDP, things like that, but they're focused on unemployment as well. And so this chart right here is really fascinating in that it shows unemployment and wages, right, in terms of unemployment rate and wage growth. And so you can see in the box in the middle, it shows unemployment rate, the average is 6.2%, and wage growth average is 3.9%. And what you look at, if you look over at 2020 and just after, you can see that the unemployment rate spiked to 14.8, and you saw wage growth really crater as well. But quickly after, right, the recovery after COVID, you see that the rates went back up on wage growth, hikes up to 7%, significantly above average, and you saw unemployment dip to really historical lows on this chart. And this chart goes back, over 50 years. So what you had was really significant wage growth, historically low unemployment, and then what that kind of was a recipe for was inflation. And so you really saw that during that time period, right? And that's what we were just talking about. So that all plays in together and why the Fed cares about the labor markets and what they want to see, and they're starting to see it here is the crossing of those two lines, right? So you're starting to see unemployment go up a little bit, very slowly, and you're starting to see wage growth come down. In fact, wage growth is very close to average right now. It's about 4.2% in January compared to historical average of 3.9. So we're getting close to where we need to be on wage growth, but we're still significantly off the average on unemployment. So the Fed's watching that. Again, talking about low unemployment and meaningful wage growth, it's just going to be a recipe for likely more inflation, kind of too much money chasing too few goods, if you will. And so this chart's showing us progress on that front. I won't spend much time on the next chart. This is kind of labor demand, but it does show trending in the right direction, right? So if you look at the left-hand chart, this is job openings, right? Job openings have come down significantly since March 2022. On the right, upper right, you see the quits, basically kind of people that are walking off the job, quitting their jobs. That's significantly down as well from when we had, kind of peaking quits, right, or people resigning. And so that's something that's to see some progress too. People are, if the job market's tighter and less people are quitting their jobs, obviously it's a little more normal for the economy. And then layoffs are also slightly creeping up in the lower right. Okay, let's talk about consumer confidence now. So this is one, this is a great chart. JP Morgan, we get our research from other third parties, and this is one of the charts that we get from JP Morgan that we think is really good. Consumer confidence in the stock market, right? So what you're looking here in the dark gray line is the data set from the University of Michigan's Consumer Confidence Index that's been around since 1971. So what that shows us is they do a poll, think of it as like a political poll. They'll reach out and they'll find out how likely are you as a consumer to make certain purchases. And the less confident you are, the lower that line gets, and the more confident you are, goes up, right? So it's kind of self-explanatory. You see the average there in the middle is 84.4. What this shows you, though, is all the low points since 1971, right? So you look at February 1975, May 1980, October 1990. You can see those low points on this chart for the Consumer Confidence Index. But what you see below that is the 12-month return, the subsequent 12-month return in the S&P 500 after those low points. And you can see substantial returns over that period, right? So 22.2% for, after the consumer confidence bottomed in February 1975, and then up 20% after it bottomed in May 1980. And you can kind of follow along on that chart and see what we're talking about. So the takeaway here really is you're looking at consumer confidence has kind of dropped off after making a recovery, right? Kind of coming back up in 2023 and 24 after a rough year in the markets in 22. And now it's starting to roll back over. In fact, this data is a little bit stale. There's a March number that just came out that I think is at 57, right? So we're starting to drop well below average again. And it's just something to think about when you think about how consumer confidence is typically correlated historically with market performance. We just tell folks that, it's a way to give you a little bit of confidence in long-term, kind of goals-oriented investing. If you're thinking about, well, when the consumer confidence is down and dropping, it could be a good long-term kind of time to think about, staying the course with your portfolio. Okay, next we're going to talk about consumer finances. So we always like to look at the health of the consumer as an important kind of, macro data that we like to, consider when we're putting portfolios together. So I won't look at everything here. Look on the right-hand side, the household debt service ratio. That's basically debt payments as a percentage of disposable personal income. So on the right, you see 11.4%. Still well below where it was, in the financial crisis, which was, end of 2007. It was almost 16% is how much of individual income was being utilized to service debt. Now it's about 11.4, and it's still significantly below even, pre-COVID, pre-financial crisis, back into the 80s. So we have a pretty good level on the household debt service ratio, but you're seeing a little bit of a some contradictory data points in the lower right chart flows into early delinquency. So what you're seeing there is, auto loans and credit cards are starting to see delinquencies that are going up fairly meaningfully. Mortgages are moving up a little bit as well, still well below the peak, and kind of financial crisis peak of almost 13%, 14%. But you're seeing that auto loans and credit cards, which sometimes can be kind of harbingers for consumer spending and maybe kind of distress, if you will, in kind of the consumer space, are going up. Although they're not alarming levels, you are seeing a trend of those both moving up. And then the next would be consumer spending and saving. I really wanted to focus on the right-hand side. I mean, the left-hand side talks about spending by category. I don't know if that's something that's super useful right now, but what I would say on the right-hand side is personal savings rates. So what you look at there is, you have average savings rate since 1960, as U.S. households of saving about 8.4% of their disposable personal income. It went way up after COVID, right, up to almost 15, 16%. And then since then it dropped significantly. 2022 it dropped significantly, but it's kind of been hovering in that 4.5, mid fours range since then, which is clearly well below average, although it's not that different from, the early 2000s, right? It seems like it's in that same range. So I think the takeaway here is that, U.S. consumers could definitely save more, probably should save more. But this seems to be kind of a new normal, if you will, with how much people are saving since the mid 90s. And you see a lot more saving kind of happening in the 60s and 70s and 80s, which, may just be a paradigm shift in how people are, consumers are behaving. But it is interesting to keep an eye on savings rates. So next we're going to talk about fixed income. Fixed income, bonds, really the same thing. This is a pretty simple chart. There's so much fixed income, so many categories. It's a huge market. The market cap is massive, and there's so many different types of bonds, right? Treasury bonds, agency bonds, corporate bonds, high yield bonds, international, whatever. So there's lots of different fixed income and bonds you can look at. This one is just using what's called the aggregate, the Bloomberg aggregate, the U.S. Ag, some people call it. Just kind of a broad-based index that tries to track fixed income bonds generally. The takeaway here is the red dots show intra-year moves in the market down, and then the gray lines show where it finished the year. So you can see over time, almost every year there's some sort of drawback, drawdown, or decrease in value in fixed income at some point during the year. And the overwhelming majority of time since 1976, you have a positive return by the end of the year. So we had a really unique kind of combination of events in 21 and 22 where we had 2 down years in a row for fixed income in terms of total return, and we haven't had that since 1976. So especially 2022, you can see that the fixed income market down 13%, the ag, which is really unprecedented for the last 50 years, right? So we're coming out of that. We have a little more normalized interest rates. Year to date, we're up 3%. Again, this is kind of generalizing, but about fixed income, we've been down as low as 1% on the year, but that's kind of a more normal year, and we expect it to kind of stay similar. And it depends somewhat on what the Fed does later this year and what the market does with rates. But if rates drop, we could see a little bit of a better year than that as we close in on the end of 2025. Okay, so let's talk about the equity market right now. So this is an interesting chart. We'll keep things simple here. Again, the equity market is so broad, we can't touch on everything. But what I want to talk about is the S&P 500. Talking about the U.S. equity markets in kind of intra-year. Again, we talked about earlier with fixed income. The red dots are the intra-year, like during the year declines in the market, and then the gray bars where it ended up for the year. That's where it closed, right? So you can see almost every year, you have a down year, at least at one point during the calendar year, and then more often than not, the market ends up. Obviously, there's some big down years in the mix. You see, 2008 in there was down 49% before it closed down 38, right? So there's some significant down years. 2022 is the same, down 19%. After being down 25 at the low point during the year. But so far this year, pretty tame, right? I mean, this is a little bit old. This is end of February, so some of the data through March has probably been more dramatic. But we can see there's going to be volatility, and it's not abnormal to have drawdowns in the market and still be fine and be on track for positive returns at the end of the year potentially. So next, we're going to talk about equity market volatility. So this is called the VIX. You may have heard about that, right? So this is basically a way to track volatility in the equity markets. This is U.S. specifically, if you will. What I wanted to do here is show 2 charts. One is the 1-year VIX, and one is the 10-year chart. So the 1-year VIX, it just gives you context of what's happened over the last year. you can see right now as the end of, this is actually really current. This is actually as of March 20th today. The VIX is off, not as volatile, not as dramatic as it was just a week or two ago. As you can recall, the markets, were taking a significant hit in early March. If you go back all the way to August, when if you guys recall, we had significant kind of volatility and market drawdown in August of last year, you see the VIX was significantly higher, right? So volatility in the market is elevated, there's no question, but it's coming off the peak where it was a few weeks ago and it's significantly below where it was in August. But if you look at the 10-year chart, you can see kind of where we are relatively kind of under 25, and there's quite a few periods above 25. So you're talking about 2022, there was quite a bit, a fair amount of the year we were over 25 in the VIX, and you go back to 2020 during COVID, it was an 83, which is off the charts really. So this kind of gives you a feel for some context over a longer period of time. And there is volatility. We expect to see some more volatility as we deal with some kind of policy uncertainty and people are looking at the Fed and geopolitical risks and other things like that. But I think it's important to look at volatility with context in the short term and kind of the medium longer term. So right now we're going to talk about domestic or U.S. versus international stocks, international equities. So we're getting a lot of questions on this lately, talking about the U.S. has outperformed over a long period of time, over many, many years on average. And the international stocks have kind of underperformed, generally speaking, a few periods of bright spots, but for the most part, they've underperformed U.S. stocks. And so, it's interesting. It's actually shifted so far year to date. We'll talk about that a little bit. And valuations are a little more interesting. So in this chart, what you're looking at here is you're looking at kind of sources of global equity returns, if you will. And you can see let's look on the far right, you can see kind of China, Europe, in terms of returns, 12.8%, 11.4%. And then it goes into the emerging markets, 2.3, US 1.4, and then Japan lagging behind that. Again, this is the end of February, so these numbers are a little different, but it gives you a feel for kind of how things were going through the end of February and how US wasn't leading the charge in performance. And you can also see global equity earnings and valuations here on this next chart. And you talk about primarily, let's look on the right-hand side. So what you're seeing is on the x-axis is US, Europe, without UK, Japan, emerging markets, and China. And what you can see is valuations, right? So you can see on the left of the US is, the 10-year range in the gray bar. The purple line is the 25-year average. Sorry, the 25-year range is in the gray bar. And you can see that US valuations are above average and kind of in the top third of the bar, if you will, 25-year range. Where pretty much every other market on the chart here is either at average or below it in terms of valuation. So the valuations are clearly more attractive international versus US. I don't have a chart on this, but there's kind of a historical offset in terms of how valuations relative to each other, U.S. versus international stocks, and international stocks are kind of historically cheap relative to U.S. stocks. But it's kind of been like that for a while, right? So, but it is something to keep in mind when you're talking about diversification and staying diversified in your portfolio, and saying, hey, well, the U.S. market keeps outperforming, kind of generally year after year for more than 10 years, over a long period of time. Well, it still makes sense to keep your portfolio diversified because there's going to be times where markets shift, and all of a sudden you're going to have international markets, international equities may outperform U.S., and you want to make sure you're participating in that. Along those same lines, let's talk about value versus growth. So growth stocks have outperformed, generally speaking, over the last decade plus, right? And so one of the things we track here on this chart on the left-hand side, it was value versus growth, relative valuations. Similar to the conversation we were just talking about with international stocks, this shows relative valuations for value versus growth. Above the green line on the left-hand side, you'll notice that growth is cheap and value is expensive. So the cheapest growth got was really during the financial crisis in 07, 08. You can see growth was very cheap relative to value. Everybody was fleeing into value stocks, and that's when you saw opportunities in growth, significant value or growth opportunities. But it's really shifted, right? Since 2017, 18, this metric has considered value stocks to be cheap relative to growth stocks, right? And so, but we've been hovering down there for 6, 7, 8 years and really haven't seen much outperformance in value. We're starting to see that finally. We'll see that here in a chart in a second. But another thing to look at is the chart on the right, value versus growth in different interest rate environments. So currently what you're seeing on the bottom is the US 10-year treasury rate ranges. We're a little over 4% in the 10-year right now. So you'd be in that second to right section, right? Where you're seeing value stocks have traditionally outperformed since 1979 when the treasury rates have been in that range. And you go farther to the right, if rates go above 5% on the 10-year, some people think they might actually do that at some point. you can see the value even outperforms more significantly. But what you see on the left is that when there's lower rates, lower Fed funds rates, growth tends to outperform more. So what we're seeing now is value's been relatively cheap. We're seeing that we're in an environment where value tends to outperform, at least in the context of the U.S. 10-year Treasury rate. And you look at this next chart, you can see what's happening year to date, right? So year to date, you can see the Russell 1000 value is up 2.3%, and this is actually through today, versus the Russell 1000 growth in the U.S. is down almost 8%, right? So that's significant discrepancy in performance and something that we really haven't seen much of over the last several years, with growth typically outperforming value. So let's talk about tariffs for a minute. There's a lot of unknowns here in the sense like how is this really going to play out? But this chart is really interesting. It basically shows all the way back to 1930, average tariff rate on U.S. goods, goods imported for consumption. And it shows we've kind of generally gradually come down since the 30s, with little blips kind of in the 60s of higher tariffs. And then we're going from, now we're kind of down near like 2.5%, looking to spike up to kind of 1930s levels on tariffs. Now, again, we don't know if this is going to stick. We don't know if these tariff rates are going to stay the same. We don't know how this can really impact the economy, if it does stay the same or it comes down partially, whatever. But this really kind of plays into our next slide. We'll talk about the kind of policy uncertainty, and I think this goes hand in hand. But you look at tariffs on U.S. imports, and we're poised under the new administration to really kind of go almost to historical highs, 100-year highs at least. It's something to keep in mind. And then, as our longtime listeners, the chart of the month, we typically throw in something a little bit different that we don't look at every month. In this particular case, it's policy uncertainty. This is a great chart by Goldman Sachs, and they look at kind of policy uncertainty since 2000. And you can see there's been a couple of spikes during that range, right? So there was a significant spike during COVID, which is clear. I mean, in my life, that was probably the most uncertainty in my life, generally speaking, not just markets, but just in general. Nobody knew what was coming. So you have elevated uncertainty in 2020, but before that, you have to go all the way back to 2001, 2002. You were kind of back during the tech bubble when things were kind of getting cleaned up. And that's when you saw, last time we had policy uncertainty this high. So, it's reasonable to be unsettled. It's reasonable that the market is seeing volatility and trying to digest of what might be coming down the pike. We just talked about tariffs. What are those really going to end up being? I think we're keeping an eye on all those things. I think the takeaway from this is, it's reasonable to have volatility and uncertainty around it. Markets don't like uncertainty, but I think this is something we're going to be in this environment for a little while. And so we just kind of have to weather the storm and keep an eye on things. So with that being said, typically our chart of the month is our closing chart, so we'll leave it at that. I would say, obviously, we go through this every month. This does not constitute investment recommendations for anybody. This is just sharing data that we think is interesting and relevant, and we encourage you to look at this information, look at other information, do your own research and due diligence. But most importantly, reach out to us if you have questions. Make sure your financial plan is updated. Make sure you're thinking about how your goals and risk tolerances may be changing over time, not just specifically to the market movements, but to your personal situation. And that's going to take a little more effort than just looking at charts. So as always, we appreciate you taking the time. Click on the link below for more information. Go to our website to learn more about the team. But more than anything, just feel free to reach out to us. We'd love to talk to you. And thanks again for tuning in. Until next time.